As of right now, Tuesday, March 17, 2026, during the live trading session, BigBear.ai, trading under the ticker BBAI, is sitting at $3.97 per share, showing a slight upward move of about 0.76% since the opening bell. It is a modest green flicker in a market that has been largely defined by heavy volatility and geopolitical tension. Most people look at a sub-$5 stock and see a speculative lottery ticket, but there is a specific reality unfolding here that the broader market narrative is missing. While retail traders are busy chasing the latest hype on their Fidelity mobile app or checking for quick swings in their Robinhood investments, the institutional layer of this stock is actually signaling a massive structural shift. You would expect a company that just saw a 38% year-over-year revenue drop in its last quarterly report to be in a total freefall, but the reality is that BigBear.ai has spent the last few months quietly performing a financial heart transplant. They have wiped out over 90% of their debt and managed to stockpile a record $462 million in cash. This is a complete departure from the typical burn and crash cycle of small-cap tech. If you are looking for investment help on your own, it is easy to get spooked by the revenue miss and the $53 million impairment charge, but when you peel back the layers, you see a management team that is aggressively trading short-term optics for long-term survival and scale. They are effectively clearing the deck so they can start 2026 with a clean slate, and that is a story you won't hear from the surface-level commentary on most investing sites. The common ground here is that everyone knows BigBear.ai is a high beta play in the defense and national security sector. The general belief is that they are constantly living in the shadow of Palantir, struggling to maintain their footing with government contracts that can be notoriously fickle. Investors see the recent revenue slump in Army programs and think the growth engine has stalled out. They think the recent acquisitions of Ask Sage and CargoSeer are just desperate attempts to buy growth because the organic side is failing. But I want to challenge that. If you look at the recent institutional activity, big players are starting to accumulate at these levels. They are seeing what I call the platform pivot. By integrating generative AI tools like Ask Sage directly into their decision intelligence suite, BigBear is no longer just a consulting firm with some software. They are becoming an essential layer of the national security infrastructure. When you look at your individual brokerage account today, you see a stock that is struggling to stay above $4, but the reality of the 2026 outlook is a 17% projected revenue growth. That growth is not just a guess, it is backed by a backlog exceeding $400 million. The market is pricing this company as if it's on the verge of bankruptcy, but their balance sheet now tells the opposite story. They have the capital to survive even if the macro environment gets much worse, which is a rare luxury for a company in this sector. Speaking of the macro environment, it is impossible to talk about BigBear.ai without mentioning the literal fog of war hanging over the market. With the conflict in the Middle East pushing oil prices above $100 a barrel, risk appetite has been sucked out of the room. This has put immense pressure on all tech names, especially those using a self-investing approach through platforms like SoFi Invest or Interactive Brokers Trading. People are rotating out of speculative AI and into safety. However, the irony here is that BigBear.ai's core business is actually a hedge against that very chaos. They specialize in decision intelligence, which is exactly what defense agencies and border security forces need when global tensions spike. Their recent expansion into the United Arab Emirates and their partnership with Abu Dhabi ports shows that they are moving into the epicenter of where this technology is needed most. The intraday movement we are seeing today is really just a tug-of-war between the macro fears of inflation and the company-specific reality of a much stronger foundation. If you are watching the Nvidia stock or Apple stock movements to gauge the health of the tech sector, you might think the sky is falling, but a small cap like BBAI is operating on a different set of catalysts. They are moving away from the SPAC-era stigma and into a phase of professional execution. It's a slow, grinding process, and it's rarely pretty to watch on a daily chart. Let's break down what this company actually does, because a lot of people just hear AI and think of chatbots. BigBear.ai is about as far from a consumer chatbot as you can get. They provide the logic and the predictive analytics for the people who manage national security, travel, and global trade. Their business model revolves around taking massive, messy data sets from government and commercial sources and turning them into actionable insights. Think about border security or customs management at a major port. You have thousands of variables moving at once: shipping manifests, sensor data, intelligence reports. Big Bear's software, like their recently acquired Cargo Seer tech, automates the inspection and risk management of that flow. It's the boring part of AI that actually runs the world. They operate primarily in two segments: cyber and engineering, and software and analytics. Historically, they have been very dependent on government contracts, which is where that revenue volatility comes in. If the Army decides to delay a program or shift funding, Big Bear's quarterly numbers take a hit. That's exactly what happened in late 2025. But the shift into 2026 is about diversifying that. By moving into commercial sectors like the Washington Commanders Partnership or the Middle Eastern port projects, they are trying to build a recurring revenue stream that doesn't just depend on a single government budget cycle. Now, I want to hear from you because this is a polarizing one. Comment below how many shares of BBAI you currently hold, or if you think the recent revenue miss is a deal breaker regardless of their cash position. I read through these to see where the sentiment is actually shifting. Looking at the institutional trends, it is interesting to see that while the total ownership rate is still relatively light, around 7.5%, the pace of accumulation has ramped up to near record highs in early 2026. These aren't just retail traders on the Robinhood app. These are sophisticated players who are using professional platforms like Interactive Brokers to build positions while the stock is under $4. They are playing the expectation versus reality game perfectly. The expectation is that BBAI will continue to dilute and struggle with margins. The reality is that the $693 million they raised through their ATM facilities and warrants has given them a massive war chest. They are now in a position to be the hunter instead of the prey. They can acquire smaller specialized AI firms at a discount while their competitors are struggling to find funding. The volatility is still high, and the technicals show a market that is still in a general decline, but we are reaching a point where the valuation is becoming hard to ignore. When you have more cash on hand than your current market cap would suggest is normal for your revenue, the floor starts to firm up. Analysts are currently split, with some cutting price targets to $5 or $6, but even those low targets represent a significant upside from where we are trading today. If you are using something like Schwab Intelligent Portfolios or other robo-advisors, you likely won't see a name like BigBear.ai show up because it doesn't fit the standard safe criteria. This is a stock for people who are comfortable with self-investing and doing the deep work. You have to be able to look past a minus 230% profit margin and understand that the loss is often driven by non-cash items like asset impairments and the fair value of warrants. In the fourth quarter of 2025 alone, their net loss looked horrific on paper, but a huge chunk of that was an impairment charge and debt settlement costs. If you look at the adjusted EBITDA, the picture is still challenging, but it is moving in a direction that suggests they could hit a turning point later this year. The future outlook here is entirely dependent on execution. The catalysts are clear. The integration of Ask Sage needs to start hitting the ARR targets of $25 million, and they need to show that the 17% revenue growth guidance is conservative. If they can land another major international contract or a significant renewal with the Department of Defense, the reality will finally catch up to the expectations of the bulls. On the flip side, the risks are just as real. If oil continues to spike and the global economy slides into a stagflationary period, government budgets might get even tighter, and the AI acceleration could hit a wall. When you are looking at your Fidelity investments or checking your SoFi active investing dashboard, you have to ask yourself if you are buying the story or the balance sheet. For BBAI, the story has been messy, but the balance sheet is finally clean. That is a rare combination in this market. Most companies have a great story and a terrible balance sheet. BigBear.ai has inverted that. They have the ugly history of a SPAC and a revenue miss, but they have the beautiful reality of a massive cash pile and zero net debt. To wrap this up, the central insight here is that the market is still treating BigBear.ai like a struggling startup with no runway, while the actual data shows they have just successfully completed one of the most aggressive financial restructurings in the AI sector. The expectation is more of the same, declining revenue and volatility, but the reality is a company that is finally funded well enough to actually pursue its long-term vision without looking over its shoulder. We have seen a shift from a company that was barely surviving to one that is now strategically positioned to